It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by firsthourtrading.com.
Welcome to this edition of the TradingTips.com video newsletter. In this episode, we'll be looking at NR4 and NR7, two takes on a short-term trading strategy that capitalizes on stocks breaking out of narrow ranges. Without further ado, let's begin. Tony Crable developed NR4 and NR7 in his 1990 book, Day Trading with Short-Term Price Patterns and Opening Range Breakout. Although the book is no longer in print, NR4 and NR7 remain popular. NR4 and NR7 work under the same principles as Bollinger Bands. Bollingers measure volatility, and the theory is that periods of low volatility, when the bands are tightening, are typically followed by periods of high volatility, and vice versa. We looked at Bollinger Bands in TradingTips.com episode 20. As you can see in this randomly selected chart with Bollinger Bands in blue, once the Bollinger Bands got sufficiently tight, the stock had an explosion of volatility. Now, with the Bollinger Bands wide, we might expect the stock to have a tighter or narrowing trading range going into the future. NR4 and NR7 are better than Bollinger Bands for shorter term trading. NR4 and NR7 work the same, as the NR stands for narrow range and the 4 and 7 correspond to how many days are being considered. We'll work with NR7 here, but the same ideas can be applied to NR4. Okay, first let's look at this chart and find its NR7s. An NR7 is defined as any trading day that has the narrowest range from the intraday low to the intraday high over the past 7 days. The narrowest range over the past 7 days is the NR7. I've identified 3 NR7s on this chart. The theory behind NR7 is to buy if a stock breaks out the next day above its narrow range, or sell if it breaks out below its narrow range. In all 3 instances on this chart, the stock here behaved as NR7 said it should. The stock continued higher after it broke out above its NR7 in the first example, and then went lower after breaking out below its NR7 in the second example. In the third instance, the stock continued lower, but only in the short term. This is why NR7 is a short-term oriented trading strategy. So really quick, let's recap what we've learned so far. The NR7 is the narrowest low to high daily trading range for the stock over the past 7 days. When a stock makes a new NR7, watch it very closely at the next opening bell. In the first half hour, is the stock trading above its NR or below it? If above, make a short-term buy. If below, then consider making a short-term short sale. Now it's time to look at another chart to see if you can find the NR7s. Take a moment. Pause the video if you need to. Determine the NR7s and what the signal coming out of them should have been. How did you do? In this case, the narrowest range over the first 7 days of the chart was the 7th day. Interestingly, the stock opened higher briefly the next day, but then fell below the bottom of the narrow range shortly thereafter. This is why NR7 requires a little bit of patience. Don't buy on a tiny breakout of only a few pennies that only last a couple minutes. Wait to see if the breakout has legs. In this case, it didn't, and the short sale was the play. We knew that when the stock actually fell below its NR7 range later that day. As you can see, holding the short sale for just 1 day would have produced huge gains. Then, 2 days later, a new NR7 was reached when the trading range was smaller than the previous NR7s. This time, a buy signal was indicated, and this would have worked out as a 1-day play. Remember, NR7 is supposed to be a short-term strategy. A third NR7 came 7 days later, once the old NR7 was no longer in the 7-day window. It would have also produced small gains. Let's look at when to buy and when to sell using NR7. These same rules work with NR4, and while both NRs can indicate a short sale, we'll just look at buying in this example to keep things simple. The examples can be reversed for short selling. Okay, NR7 says to buy after a stock breaks out above its NR7. Make sure the move has legs though. Watch the stock in the first 30 minutes of trading. What should your price target be? Many traders sell at the end of the day, no matter what. A more aggressive strategy is to hold until the play is profitable, even if it goes bad. How about a stop loss? Well, some traders don't use them. Remember, some of them will hold until the play goes good. Others will use a trailing stop, and a more advanced strategy is to use parabolic SAR to establish a stop loss. Parabolic SAR was covered in an earlier episode of the TradingTips.com video newsletter, and you can find out more information by searching for parabolic SAR at TradingTips.com. In conclusion, NR7 is a short-term trading strategy, generally for one-day trades. NR4 is an alternative, but it's still a short-term strategy. Both NR strategies operate under the theory that low volatility begets high volatility, and they then try to identify stocks with recently low volatility. This strategy seems to have a high probability of success, but it is not suitable for longer-term traders. As always, there is an increased risk with day trading. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Backus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit tradingtips.com. Sign up for our free video newsletters and become a successful trader today.